Imagine stepping into the autumn of 1907. The air is brisk, the sky a clear blue, and you decide to stop by your bank for cash. You reach the granite steps, only to be waved back. Questions get you nowhere. Clerks avoid your eyes, doors click shut, and by evening, you learn a cruel truth. You cannot withdraw your own savings, not even a single cent. That unnerving scene captured the mood of the panic of 1907. A crisis ignited by two men largely unknown to the public who believed they could game the market and walk away rich. Their plan imploded, unleashing a storm that sent money rates from comfortable single digits to breathtaking triple digits within days. The New York Stock Exchange shed nearly half its value. Commodity prices fell by more than a fifth. Failures and bankruptcies piled up. At the core of it all stood F. Augustus Heinze and Charles W. Morse, daring operators whose appetites outgrew their judgment. But the powder keg had been filling for months. The American economy already showed cracks. By the way, if you love money, subscribe to the channel and give it a like. Now let's continue. In April 1906, San Francisco was devastated by earthquake and fire. Roughly 3,000 lives were lost, and property damage ran to about $400 million, a sum that converts to the tens of billions today. British insurance companies faced enormous claims, and the gold to pay them flowed out of London. The Bank of England raised its rate. American financiers tightened credit in sympathy, and money thinned across the states. Banks guarded reserves. Businesses hesitated. A general brittleness set in. Into that environment walked Heinze, battle-scarred from Montana, and Morse, the self-made ice king, flush with influence. Each saw opportunity where others saw danger. Heinze's reputation had been forged in Butte. There, the Amalgamated Copper Combine, closely aligned with Standard Oil, dominated the district. Heinze did not challenge it out of idealism. He saw angles. In 1895, he bought the Raris mine, hard against Amalgamated's holdings, and waged war on two levels. Above ground, he filed and fought a blizzard of lawsuits. Below ground, his crews drove drifts that edged beneath rivals' lines, punching through and extracting high-grade ore worth more than $1 million under the banner of Montana's peculiar apex laws. Judge William Clancy, an ally, delivered opinions that regularly favored Heinze's interpretation. For a time, the upstart seemed to have cornered a behemoth. The campaign, though, was ruinously expensive. Injunctions, appeals, and countersuits consumed cash. By 1906, the tide turned against him. He sold out of Butte and moved to New York, scouting fresh ventures. There he met Morse. From youthful arbitrage on Kennebec River ice to a consolidation of the East Coast's ice trade into the American Ice Company, Morse had turned improvisation into empire. He broadened his reach by acquiring the National Bank of North America and the New Amsterdam National Bank, investing in the Mercantile National Bank, and threading his influence through trust companies and insurers. He knew how to bend the city's credit rhythms to his plans. To Morse, Heinze looked like a partner who could take big swings. Backed by Morse, Heinze collected posts across banks and trusts. Together, they embraced a plan from Heinze's younger brother, Otto. Corner the shares of United Copper, and spring a short squeeze. Short sellers had, Otto believed, bet heavily against the stock. If the clique absorbed most available supply, the shorts would be forced to repurchase at climbing prices, turning the squeeze into a mint. That required money lots of it. And for that, they leaned on the Knickerbocker Trust Company, presided over by Charles T. Barney, who had dealt with both men before. Trust companies, unlike national banks, ran with much thinner cash cushions and lighter regulation. They were central to Wall Street's daily funding, dispatching large, short-term loans to brokers who then pledged to purchase securities for call loans at national banks and repaid the trusts before nightfall. The mechanism was elegant when confidence held. It shattered when rumors surged. Otto had misread the true float of United Copper. Opponents located shares beyond his reach. On October 15, 1907, the price broke. The squeeze inverted, losses ballooned. Then fear generalized. Connections between the Heinze-Morse circle and Knickerbocker came to light. Withdrawals that started quietly grew into queues. On the morning of October 22nd, crowds massed outside Knickerbocker's grand building. Tellers slid out stacks of currency until the tills ran low. By early afternoon, roughly $8 million had been paid and the doors closed. Knickerbocker would not reopen for months. The city's papers tried to soothe the public, reflecting assurances from the clearinghouse that support was forming. But trust once shaken is slow to return. If a leading trust could fall, why not others? Institutions that had extended funds to firms linked with Heinze and Morse called loans and hoarded cash. Brokers sold to survive. The call money rate spiked, racing from around 10% toward levels that brushed 100. At points, lenders refused to quote. Without credit, payrolls failed, inventories clogged, and companies toppled. The exchange sagged toward a 50% loss from highs. Commodity indexes fell more than a fifth. Failures surged. Unemployment leapt as factories went dark and offices thinned. Unlike later eras, the United States had no Federal Reserve to flood the system with liquidity. There was no automatic lender of last resort. In 1907, the role fell to a single private citizen with outsized standing, J. Pierpont Morgan. He summoned the city's leading financiers to his library and made it plain that they would stay until a plan emerged. They compared balance sheets and drew a line between firms that were illiquid and those that were insolvent. Through the small hours, Morgan cajoled, threatened, and stitched together commitments. The next day, announcements came. A pool was assembled to support the Trust Company of America and stop its run. A roughly $25 million subscription of call money steadied the brokerage community. Large purchases of municipal bonds ensured New York City could meet payroll. These moves signaled control and bought time for markets to breathe. Knickerbocker, however, received no rescue. Morgan refused, arguing that failure had to mean something, lest speculation metastasize unchecked. The personal consequences were swift. Heinze and Morse were forced from their bank and trust company positions. Heinze's fortune and health eroded. He died a few years later. Otto, architect of the squeeze, was expelled from the New York Stock Exchange and drifted into obscurity. Morse faced prosecution for federal banking offenses, fled briefly, and was captured and sentenced to a long term. In prison, he crossed paths with Carlo Ponzi, a name that would later define an entire category of fraud, though what advice passed between them is uncertain. Meanwhile, Charles T. Barney, disgraced and ousted from Knickerbocker, returned home on November 14, 1907, and took his own life, another tragedy in the chain. As panic ebbed, public gratitude for Morgan mixed with suspicion. How could a single financier wield such authority over national credit? Congressional investigators mapped money trust linkages and interlocking directorates across banks, railroads, and industrial firms. The hearings did not dismantle concentration overnight, but they reframed the debate. Many concluded the country needed elastic currency and a public apparatus to discount paper and lend in emergencies. Out of private conclaves at Jekyll Island and subsequent compromise came the Federal Reserve System in 1913. To understand why trust companies amplified the shock, examine the plumbing. Wall Street's brokers required morning funding to buy stock, and trusts supplied it. They were allowed to carry far lower reserves than national banks, which made them profitable in calm periods but brittle in stress. When depositors questioned a trust's health and stormed the lobby, the firm sold assets or declined to roll loans, starving brokers of cash. The resulting fire sales pushed prices down and triggered more calls. Clearinghouse associations tried to break the loop by issuing loan certificates, IOUs that functioned as settlement money between banks, allowing currency to be conserved for depositors. Merchants sometimes accepted the paper, and payrolls were patched with scrip. Imperfect, yes, but it slowed the spiral long enough for Morgan's pools to bite. The human dimension was raw. Lines formed before dawn. People clutched passbooks and stared at brass doors. A lucky few left with envelopes of cash. Others stared at closing notices pasted to glass. In warehouses, deliveries paused. On railroads, orders were deferred. At mines, shifts were cut. The statistics repeated in histories: stocks down almost half, commodities off by a fifth, failures up by nearly half were aggregates of these small shocks to families and firms. The Panic of 1907 became a civic parable. It taught that the absence of a formal backstop turns every rumor into a test of survival. It showed that entities that behave like banks but escape bank rules. Then trust companies, later shadow lenders, can transmit stress with terrible speed. It revealed how charismatic operators, emboldened by past wins, can overreach once and bring down much more than their own fortunes. A century later, the parallels with 2008 were chilling. Where Knickerbocker was outside the safety net, so too was Lehman Brothers. Where Morgan organized private rescues, modern officials built emergency facilities and persuaded solvent institutions to merge with stricken ones. The Bear Stearns backstop recalled the ad hoc lifelines of 1907. New statutes, most prominently the Dodd-Frank Act, expanded oversight and demanded plans for orderly failure to prevent panic from turning into systemic collapse. The names changed, the mechanics of contagion did not. Return to the opening image. You, a depositor, turned away from your own money on a bright October morning. That memory reported in headlines and whispered in tenements helped propel reform. It explains why the Federal Reserve exists, why clearing houses adopted stricter collateral standards, and why regulators fixate on the gray zone between banks and not quite banks. Liquidity must be available not just in sunshine, but in storms. Viewed from today, the story is more than old finance. It is a lesson in design. If the system's plumbing is transparent and resilient, if reserves are real, settlement works, and backstops are credible, then even hard shocks are survivable. If not, ambition and rumor can lock arms and take the country to the brink. That was the warning in 1907. It echoes still. Now, a closer look at the sequence from rumor to run clarifies why speed matters. First, a large visible institution is implicated in a failed speculation. Second, counterparties pull lines. Third, the public sees smoke newspaper headlines, whisper networks, a crush of bodies in front of a single door, and assumes fire. Depositors withdraw, not because they will need cash today, but because they fear others will need it tomorrow. That coordination problem is the beating heart of bank runs. In 1907, without deposit insurance and with trustees juggling slim reserves, the only force that could reverse expectations was a credible show of collective strength. Morgan provided it by corralling competitors into acting as a single balance sheet. Inside his library, he assigned inspection teams to trusts and demanded data loans, maturities, collateral. The process separated candidates for aid from hopeless cases. By announcing support for one trust while denying it to another, he practiced a crude but unmistakable form of triage. The message to the market was that some institutions could be protected because they could be saved, while speculators who had built houses on sand would swallow their losses. That line drawing was controversial but effective at restoring confidence among cautious depositors. Over the following months, calm returned. Knickerbocker reopened in 1908 after restructuring, but never regained its shine and was absorbed a few years later. Heinze was expelled from polite finance. The brother who devised the squeeze faded away. Morse served time and, in prison, met Carlo Ponzi. J.P. Morgan, hero to some and suspect to others, would die in 1913, the year Congress created the institution that would distribute the job he performed by force of will. Set alongside 2008, the rhymes are almost musical, runs transmitted through funding markets, official attempts to separate liquidity problems from insolvency, rescues of some firms, refusals for others, and, afterward, sweeping changes to rules and oversight. The key insight is simple. In finance, confidence and cash form a loop. Break one, and the other vanishes. That is why the Panic of 1907 remains required reading. It is not dusty trivia, but a map of failure modes and a guide to building guardrails. Keep the image of locked bank doors in mind the next time headlines shout about a run, a freeze, or a rescue. Behind the drama lie the same mechanics that terrified the city in October 1907, and the same remedy. Transparent balance sheets, ample liquidity, clear rules, and leadership quick enough to act before fear outruns facts. Consider the legal terrain that enabled Heinze's Montana victories. The apex doctrine allowed a miner who owned the apex of a vein at the surface to follow that vein underground, even if it wandered beneath another claim. In practice, mapping was imperfect and disputes were endless. Heinze turned that ambiguity into leverage, using injunctions to paralyze rivals while his crews extracted ore. Those habits finding and exploiting gaps between statute and practice followed him to Wall Street. Morse's habits were different but complementary. Assemble franchises, align political friends, and build a lattice of companies that looked separate on paper but functioned as one machine. The United Copper play fused both styles, legal gaming and financial engineering. Why did short sellers resist the squeeze? Because true control was illusory. Shares could be borrowed from unexpected corners. Holders who were not part of the clique sold into the rally. Banks that might have supplied cash grew cautious. Cornering a stock is like trying to hold water in a net. Any hole defeats the plan. Once the market sensed the corner leaking, buyers vanished and the price snapped down. Those who had levered up to buy on the way up faced margin calls on the way down. Trust companies' fragility deserves emphasis. With reserve ratios far below those of national banks, they delivered higher returns in placid times. But that same thin cushion meant that even a moderate run threatened survival. Worse, their role in the daily funding chain meant that a wobble at one trust could cripple many brokers at once. In 1907, contagion did not travel primarily through complex derivatives. It traveled through the simplest instrument of all cash. The clearinghouse loan certificate is a fascinating artifact. When currency grew scarce, banks effectively printed promises to each other. Those certificates allowed settlements inside the banking system to continue while depositors were paid with actual notes and coin. To a modern reader, that solution resembles central bank liquidity minus the central bank. Merchants sometimes accepted certificates at a discount, evidence that, in crisis, society stretches the definition of money. The press tried to calm nerves, but slow editions let rumors outrun headlines. That lag made dramatic interventions doubly important. They wrote a counter-story in real time. Morgan's lock-in has been retold as legend, but it was also logistics. Committees fanned out to inspect vaults, interview managers, and audit assets. Solvent institutions were promised support if they opened their books. Insolvent ones were left to fail quickly so that pain would be concentrated rather than smeared across the system. The philosophy was brutal triage. Save what can be saved, bury what cannot. Let everyone see the difference. The moral accounting arrived soon after. Investigations challenged the ethics of men who had accumulated such sway over finance. The Pujo Committee's maps of influence did not outlaw concentration, but pushed the conversation toward structural reform. Out of that conversation came reserve requirements, a lender of last resort, and a recognition that lightly regulated entities' trusts. Then, shadow banks later can be as systemically important as any traditional bank. Against that backdrop, the human fates of our principles feel almost classical. Heinze faded, his health broken. Otto, who authored the fateful idea, vanished from the center of finance. Morse, prosecuted and imprisoned, encountered Carlo Ponzi, whose name would soon label a template of fraud. Barney, stripped of office and reputation, ended his life. Each outcome was a note in the larger chord, private ambition colliding with public damage. Jump ahead again to 2008 and the rhymes continue. Repo markets and money funds function like the trust company pipelines of old, moving large sums on short notice. When confidence cracked, lenders pulled away and forced sales began. The state stepped in where a century earlier Morgan had, deploying alphabet soup facilities, capital injections, and guarantees. Afterward, new rules hardened the plumbing stress tests, living wills, limits on leverage. So rumors would not freeze the economy. What should a citizen remember from 1907? 3 ideas. First, liquidity is about time. Sound assets can kill you if you must sell them now. Second, opacity is a tax on confidence. When balance sheets are unclear, whispers win. Third, leadership is policy. In a panic, decisive action communicates as loudly as cash itself. Those lessons live in modern backstops, from deposit insurance to emergency lending powers. Picture again that closed bank door and the crowd on the sidewalk. Their fear was rational in a system without guarantees. The reforms that followed. Central banking, clearing rules, disclosure, were a social decision to replace improvisation with institutions. The goal was not to eliminate cycles, but to prevent panic from consuming the real economy. That is the inheritance of 1907, and the reason its echoes still matter. In sum, the panic of 1907 was the product of a fragile structure jolted by reckless speculation, transmitted by brittle funding channels, and alleviated by improvised cooperation. It left behind a blueprint for stability, credible reserves, transparent books, disciplined collateral, and a lender of last resort. Whenever those elements are missing, history starts to rhyme, and the lines sound very much like October 1907. If you made it this far, drop a plus in the comments of your badge for finishing the deep dive. And if you haven't already, subscribe for more long-form stories where money, history, and power collide. Curious about earlier empires of capital? Check out our others video.